you are the first person who have agreed to be with part of this webinar series on the regional level, state level webinar. Friends, let me just tell you one thing is my association with Nizamabad has been, my grandfather used to stay there. So that is one of the most important heart-touching feelings which I have, and who better person than can be when a person like PVSS Prasad sir, if you all have seen my message, I said, a institution walks when he walks, and that is the kind of knowledge he carries. That is the kind of command he carries. Today, when you talk about very large firms, I don't want to name specific, but when you talk about very large firm, the only person who can stand from our SMP practice is Prasad sir. Very tall, very heavy in the entire subject as such. That gives a lot of confidence when we look at these kind of person who have set an example, and we should actually follow them. Take their a small portion of their entire knowledge also will make whole lot of difference, because they have seen the entire transition of this entire country as such, the profession as such. I know the family very well because of my father. I am fortunate that, because of father, I get connected with all the senior members, and also I am connected with my junior members. So if it is past, present, or future, it has been, I am really lucky to act as a bridge in the entire, bandwidth of our profession. But Prasad sir, having you here is something like, all these people are going to get advantage, and the best, inputs they are going to get. Today, the topic itself is such fantastic. Hats off to Pankaj Bhai. He could actually initiate this thought process, and then Funny immediately said that we want to host it. And the immediate action was, yes, we have to encourage our chapters, whether it is CP credit there, not there, doesn't matter. It is basically a knowledge which is available. We can always remember the story of Ekalavya, who stood behind, trees and learned. But here it is matter of learning from, our own webinars, our own sessions, our own people. We might be looking at people virtually, but the kind of knowledge which is going to be shared is something very interesting. The series which we followed last 10 days is almost a continuation, I can feel, when you talk about digital taxation at digital taxation at the India level. Sir, I don't want to talk much about that subject because you are the person who are there, and having you, trust me, it is like, having the institution with us. You have been participating in so many seminars. You have been participating in all the areas that we have seen you, the way that you actually give the knowledge to the members as such. So this is beginning of Nizamabad chapter. I think this will be a very big blessing for all of us to start with. And very soon we are going to work with Karimnagar and Warangal also. I was trying to reach them yesterday, but I could not. But today and tomorrow we are going to take it forward, so that our own Telangana is actually a very small state when compared to many of them. But if we come together, I think we can stand united, and we can face any kind of situation which is there. So, Funny, I request you to take the session forward and see that the things are being taken care. Even I am going to be there all throughout the session, sitting before the system. I am just going to switch off my camera. But, and Pankaj Bhai also will be doing the same. So you also try to be there. And if anything is there, we'll coordinate and get it done. So welcome, Prasad sir. Thank you very much. Nizamabad is very close to my heart, and having you is like you are on our you are the we are proud that you are a member, and you give us that kind of feeling always. Thank you very much.
Funny, unmute
Funny,
yourself.
over to you.
Yeah, Funny, unmute
before,
yes. Okay.
Yeah, sir. Before handing over the session before commencing the session, I would like to give a brief introduction on Sri PVSS Prasad Garu. PVSS Prasad is a practicing chartered accountant and an information systems auditor, partner in Prasad and Prasad Chartered Accountants, Hyderabad since 1986. He is past chairman of Hyderabad branch of the Institute of Chartered Accountants and past president of AP Tax Bar Association, past chairman of International Fiscal Association, Hyderabad sub-chapter, and past member and executive committee of International Fiscal Association India branch. He co-authored a book titled International Taxation, a Basic Study, published by Book Corporation, Calcutta. He was appointed as one of the branch reporters for IFA Congress 2010 that was held at Rome, Italy, on the subject of tax treaties and tax avoidance, application of anti-avoidance provisions. He was chairman of All India Federation of Tax Practitioners, South Zone, 2010-11. He was co-opted member of Committee of International Taxation Institute of Chartered Accountants of India, 2016-17. He was invited to speak at IFA Asia Africa Conference in Mauritius in 2012, 2014, and 2016. He is a co-opted member of Committee of International Taxation, the Institute of Chartered Accountants of India for the year 2018-19. The elected vice chairman of IFA India branch 2018-20. He was invited as panelist at Asia Pacific Regional Tax Conference 2016 held in Seoul, South Korea in May 2016. So I invite Shri PVSS Prasad Garu to take charge and start the session. The topic is digital taxation.
Yeah, and
Over to you, sir.
Yeah, just 1 second, Prasad. 1 second. I request everyone to please put the questions in question answer section only, so that it will be easy for the speaker to take it, because in chat a lot of other things should also come on. Yeah, over to you, Prasad.
Thank you, Mr. Fani, Chairman of the Nizamabad chapter of the Institute of Chartered Accountants, and my good friend Mr. Pankaj Trivedi, Mr. Dayanivas Sharma, Central Council member, a very dynamic Central Council member, doing his best for the Institute, and we're really proud of you there. And I'm very thankful for the kind words of Daya, Fani, in introducing me. I don't know whether I deserve all the compliments what they gave. And anyhow, I strongly believe it's a continuous process of education. We are all together in that, always. There is no doubt about it. And today's chapter is no more a Harry Potter novel, which we have been thinking in the past. It is a reality, and digital taxation is going to be a reality anytime from the end of 2020 December. What is digital taxation? Is it a rocket science? No. And what is happening around us is what we are going to discuss today. And as you all know, the business models what we had 50 years back are different from the business models what we had 100 years back. Same way, the business models what we have 25 years back are different from the business models what we have today. And in fact, any law, more so a tax law, should definitely be dynamic enough to change itself in tune with the changing times. So, before setting the ground, I would like to just take you through the history in a very brief manner, why we are discussing today the concept of digital taxation, which is all pervasive today, and we are already into that, and how we'll have to manage ourselves and what would be the taxing principles we are going to know. Friends, in 2008, today we have this COVID-19 pandemic, and already all the economies are now crumbling, and we don't know how far this effect would be there. And everyone is trying to how to come out of this crisis. First of all, become safe from the health angle, and then try to look at the health of the economy. Similarly, we had, though not at this magnitude, but in 2008, when Lehman Brothers crumbled in US, along with other corporations facing the bitterest, the bitterest days of the businesses they had, and when the economies really started having a spiraling effect of such large corporations crumbling in US. We all had the impact in 2008 and 2009 across the world. That was the real economic meltdown or recession which we all experienced. And India is no exception. But India was very resilient and it could come back very fast, unlike other. Just give me a minute. I forgot to plug in the charger. Just 1 minute.
We have been getting suggestions for him to speak louder. As of now, the sound is clear. But if it comes down slowly, I will point out to him. In between, please also adjust your audios also.
Please.
Prasad, couple of suggestions came asking you to increase your volume, but the later part was okay. So just take care of it. Thank you.
Okay. So 2008-9 had been a very, economic meltdown years of countries across the world, and India is no exception. And then all large economies started looking at their coffers and found that the tax collections are not up to the mark. And large corporations like Google, Yahoo, Starbucks, Apple and all that are not paying taxes to the extent they're supposed to. And they're able to manage their affairs in a way that hardly 1% of their total sales revenue is being paid as taxes, 1 or 2% maximum. So with all creative tax planning and taking shelters in low tax and nil tax jurisdictions, tax havens and all that. Then OECD, Organization for Economic Cooperation and Development, is a congregation of tax gatherers headquartered in Paris, France, and where all these advanced economies are members. India is not a member, India is an observer. They have come up with an agenda to find out where these tax leakages are happening and how to get over that and try to come out with effective anti-avoidance measures. It is nothing but an agenda to bring in effective anti-avoidance measures. And in that, they have come out with 15 action plans released in October of 2015. The first and the foremost action plan is how to meet the challenges of digitalized economy or digital taxation. It was learned that the way in the business is happening is altogether different from what it was in the past. And especially techno giant corporations like Google, Apple, and Facebook and all that, their business models were never conceived in the past. And the way in which they're operating across the globe with huge revenues and the models they're operating, it was just beyond the comprehension of the tax system what we had. So that was the reason, out of the 15 action plans identified by OECD, which is immediately supported by G20 countries, where India is also a member, and that particular combination of OECD, G20 gave all the impetus to come out with these action plans, which are nothing but anti-avoidance measures, and ensure that the tax leakages that are happening are arrested and the due taxes are recovered by each economy respectively. The first and the foremost action plan is to meet the challenges of the digital economy or the digitalized economy. They could find that the way in which these technology companies are operating is mind-boggling, and the way in which they are able to reach out to the markets across the world is unimaginable. And the revenues they are earning is simply mind-boggling. And the most important observation made by OECD G20 initiative is they are able to earn income in a particular country without any physical presence. That is the most important thing which you need to know. See, all through the existing international tax rules provide that if at all you have a company, say in US or in Europe, and you want to start your business in India, you will have to have your physical presence in India in the form of a branch or a factory or a workshop or an agent and all these things. That means your physical presence is important for you to trigger the tax presence in the source state. In the example what I'm talking, like India. Suppose you are a company from US and you are trying to do business in India, and if at all you are to be taxed in India, your physical presence must be available on a permanent basis, then that is called a permanent establishment. Unless that permanent establishment triggers, the Indian government would not have a right to tax that US company only in respect of such profits earned relating to the activities carried out in India. Okay. So the earlier existing tax rule insists physical presence of the corporation or the business entity or the enterprise to get taxed in the source country. Here, in the example what I am discussing, the company is a resident of US and then it is trying to make an earning in India. That India is called, in this example, a source country. A source country means a country where a source of earning is being generated by the US company. So such source can be taxed in this country only when you have presence, which is otherwise known in international tax parlance as permanent establishment. So such permanent establishment rule is wholly dependent on physical presence. Please remember this for the whole of our discussion. Okay. And international taxation is not a rocket science. It is easily understandable, but the only thing is you need to know the basic international taxing principles. So when a branch of a US company is set up in India in a physical form, then the Indian government will get a right to tax that branch only to the extent of profits generated by that branch in respect of the activities carried out in India. That's all, not beyond that. So that is what is called the attribution of profits to a permanent establishment, in this example, a branch of a US company. Okay, here what they found in 2015 is 2013 onwards this OECD agenda started. In 2015, when they released these action plans for corrective actions to be taken and for modifications to be brought into the double taxation avoidance agreements, they found that this digitalized businesses taxation has become so complex, they could not arrive at a solution. So that is the reason action plan 1 was kept open-ended. They have not closed that action plan because they didn't have a solution on their hand, and they have made only recommendations, and they have taken a pledge to carry forward their relentless work and then arrive at a solution how to tax companies in this digital environment. Okay. And as I mentioned, they found companies like Google, Facebook, they are able to earn billions of dollars from countries like India and other Asian countries, Japan, everywhere, without any physical presence, thereby they are getting over the existing rule and they are not liable for any tax in this country. But it is very evident they are making huge revenues from this country. Then it is very, very apparent that the existing international tax rule is ineffective in dealing with this type of digitalized businesses. So all of you know, all of you use Facebook, most of you are using Facebook, how they are able to gather data of users across the world. Because they have such a huge user base and huge advertisement revenue they are getting from large corporations. Their revenue is coming from the advertisements and not a single pie from the users. In the same way, today you have Google apps, whatnot, you have Google Maps, you have got Google Play, you have got Google Assistant, you have so many apps. You are not being charged even 1 rupee or $1, but the entire data of the users across the world is with them, which is their real strength, which is their IP, which is their intellectual property, which is helping them earn billions of dollars and from large corporations on advertisements. So this type of business models where Google can get into the entire mass across the country without any physical presence is mind-boggling, and there has to be a solution to ensure that such type of transactions also get taxed in the respective countries depending on the revenue they generate or the activity they carry out. Please bear these opening remarks in your mind, very important for our discussion today. And with this background, the action plan 1, which was kept open-ended, not closed, whereas all other action plans, they have given final action plans, and already the action plans have transformed itself into respective rules in the form of a multilateral instrument. MLI is an instrument which is signed by almost around 100 countries today. The MLI's job is to bring this anti-avoidance measures with respect to PE, with respect to so many other activities of the international businesses. And these are all anti-avoidance measures. These anti-avoidance measures are meant to be brought into existing tax treaties, which are as many as 2,500 to 3,000 tax treaties across the world. You all know what is a tax treaty. Tax treaty is entered into between two countries to avoid double taxation. In the example I gave, US company comes and does business in India, let us say, by opening a physical office. Even Google has got a physical office in Hyderabad, and Delhi they have, and they have an office in Bangalore. There, what all activity they are doing, that is being captured for the taxation purpose in India. The real revenue what they are generating doesn't require physical presence. So what I mean to say, when a branch in India is getting taxed in India because of its physical presence, this branch profits get consolidated in the head office in US. And when again US tries to tax the entire global income as per the residency rule, then the branch profits will get taxed again in US. That should not happen. That would amount to double taxation. That is for what we have the double taxation avoidance agreement to avoid double taxation. That is called a tax treaty or a double tax convention. India calls it as a double taxation avoidance agreement, DTAA. So in order to bring all these anti-avoidance measures which are suggested by the action plan 2 to 14 have been brought into action plan 15, which is called a multilateral instrument. Multilateral instrument, when it is a DTAA, double taxation avoidance agreement, 2 countries only will sign, whereas multilateral instrument, 100 countries, 150 countries, 200 countries will sign. Why MLI? MLI is advised by the international tax experts to enter into, to bring in quickly the amendments to the existing tax treaties Am I audible, Pankaj?
Yeah, sir, Prasad, you're audible, but are you moving the PPTs
No, no, I
that
have
you are?
not yet started.
No,
I have
no,
not.
because yeah, a couple of things
No, no,
I
I have
got.
not yet started.
No
I
problem.
will,
Carry on,
I will,
Prasad. Sorry.
I'm laying the foundation.
Yeah, yeah,
I
right.
will start in a couple
I
of
thought
minutes.
about it, but just I thought I'll.
So I'll just move to the,
No, no problem. We thought it got stuck up. That's all.
okay, okay, no, no. So what I mean to say, uh, I mean all these anti-avoidance measures to be brought quickly and swiftly into the existing treaties, as many as 2,500 to 3,000 treaties. The quickest and the effective way is the multilateral instrument, where all countries come together and sign one agreement, one instrument. That is called multilateral instrument. And this multilateral instrument will function alongside with the existing treaties, provided both the treaty partners of each treaty notify their respective treaties for the intended modification to be brought into their treaties. So that is a subject by itself. I'm just giving the background of what is a multilateral instrument. Even you need not be so much upset or worried about what is this multilateral instrument, what is this new animal. We know how to get along with any type of animal, and we are known as the best fraternity to cope up with the changing times. So that's not an issue at all. So I'm just giving you the background about the other action plans. The 15th action plan is the multilateral instrument, which became a reality. India is one of the front runners. It has signed the MLI on 7th of June 2017 in the first signing event, signature event, along with 67 other countries in Paris. And today it is ratified by the Union Cabinet and ratified and submitted to the OECD, and it became effective from 1st of April 2020. Multilateral instrument is a reality, and that needs to be discussed by the Hyderabad branch separately in a separate session. Be that as it may, coming back to the first action plan, from the time October 15 till date, OECD G20 has been further expanded into an inclusive framework of as many as 137 countries today. That's called OECD G20 Inclusive Framework. It's as many as 137 countries are working together to bring a consensus, which they have achieved by bringing the MLI, and then they want to bring similar consensus with respect to taxation of digitalized economy. That means digital taxation. So in this regard, let us see what is the journey they have taken from 2015 October onwards till today, and where we stand today, and what is the agenda that is there, are eager to arrive at right as per a new rule to tax a digital corporation in the market country where they earn a lot of revenue, in spite of such digital company not having physical presence. How this taxing right is being visualized, how it's being debated. Let us just quickly get into the presentation. As the Pankaj suggested, all of you can come up with your questions at the end of the presentation. And let me quickly get into the presentation, because I thought I had to lay a strong foundation without which your understanding would not be comfortable. And if there is no comfort, I'm the last person. I would always think that I have not done my duty properly. Anyhow, what is digital taxation? Tax levied by the country of a market on profits earned from digitalized business is called digital taxation. This is a very broad understanding. There is no definition of digital taxation in any act as on today. This is the understanding this is the common understanding we're trying to take. The name of this tax has changed several times. In 1990s, it is called e-commerce taxation. Then it is called digital taxation. Then they realized even that is not the correct coining of the words. it has to be taxation of digitalized economy. What they have found is even automobile companies, pharma companies are digitalizing their businesses in many segments, which are making their businesses digitalized, if not wholly, at least partially, which is giving them a leverage to reach out to the markets in a more effective manner than what they were doing in the uh, earlier old approach through physical presence and all that. So then is there a need for change in the international taxation system? There should be, because the existing tax rule insists that you must have physical presence, then only you can be charged to tax. Google like company does not require a physical presence. Facebook does not require a physical presence. It can earn billions of dollars with their algorithms, software, multi-sided platforms, and whatnot, mind-boggling software, softwares they have, they can implement, and across the world, they can earn billions of dollars without physical. Then what should be the new taxing right? Yes, there is a need for change in the system of taxation due to the following main reasons. What are the main reasons? Inadequacy of the old law to deal with the modern business models. Today, you are not buying Today, you are not buying goods, going to a shop. Every day, you have a demand at your house from the Home Ministry that you must order something on the online, or she herself will order something on the online. So Amazon is going to deliver the goods. Flipkart is going to deliver the goods. So inadequacy of old law to deal with modern business models and residence versus the source conflict. Residence versus the source conflict means in any double taxation avoidance agreement, what is being agreed upon by two countries? In the example I gave, a US corporation opens a branch, physical branch in India, then who is getting the branch? It is India, because India's public infrastructure is used, and then branch has progressed its business activity in India. The first taxing right against the branch profits lies with the source country, that is India. And then this income gets consolidated in the overall income of the US company in US, and the taxes paid in India would be given as tax credit against the overall taxes they have to pay in US. This is called the tax credit mechanism to avoid double taxation. Okay, it is with reference to active business income. There could be incomes like royalty. A US company would have given its know-how to an Indian company to manufacture a particular product, engineering product. Then, against the know-how they have given, they would get royalty from the Indian company. That is called a passive income. Otherwise, there could be an interest income, there could be a dividend income. All these are passive incomes. Passive income, the international tax rule is the source country. Source country means from where the payment is being made. That means a person who has availed the technical know-how is making the royalty payment to the US company, then he will deduct tax at a particular rate as agreed in the double taxation avoidance agreement, or the rate prescribed under the domestic law, that is the Indian Income Tax Act, whichever is more beneficial to the non-resident of US. So that is called section 90 subsection 2 allows you, that is the non-resident, to be governed by the provisions of the domestic law of the source country, that is India, or the provisions of DTAA, that is India-USA tax treaty, whichever is more beneficial. Suppose the India-US tax treaty is imposing 15% tax as the tax to be levied in the source country against the royalty, whereas our 115A is only giving 10% tax rate against royalties, then you can get governed by 115A and need not follow tax treaty. Tax treaty can always give you only beneficial treatment and not a more stringent treatment. And tax treaty is always relieving in nature and can't impose any new taxes. Okay, so why I'm telling this, the passive income tax rates are shared. That means the royalty is taxed both in India and also in US. You suppose you tax at 10%, that is not the end of taxation. They would give credit for this 10% in US, and if at all they are charging this royalty at 20% or 21%, they will collect the balance 11% in US. That is the reason passive income taxing rights are shared by both source country and also the resident country. And whereas the active income taxing rates are given in an unrestricted manner to the source country first, and then it would be consolidated, and whatever tax paid here will go to the resident country as a tax credit. Okay, I'm just giving this background for your understanding. And now, why I have explained all this is the residence versus the source conflict. Okay, many a time now Google says, unless the new tax right rule comes, Google says my source of income of earning billions of dollars from India is not in India. Hence, you have no right to tax me. The source is there in Ireland, where I have got the intangibles, not even in US. Okay, you don't have the taxing right to tax my revenue, though I am getting huge revenues from India. That is where there is a conflict where the source lies, whether the source lies in India or outside India, in spite of huge revenue being generated from India. So that is where you have a residence source conflict. Earlier also it is there from always. This is a very important concept in the international taxation, more so in the context of digitalized businesses. Then why the old law is ineffective? Because the old law is dependent on the physical presence, which physical presence is being conveniently avoided by all these large corporations. Thereby you are losing the right as per the old existing international tax rule. In the absence of PE due to non-physical presence, country of market like India, though Indian users or Indian payers to the advertising revenue or whatever it is, they are paying huge amount, it is not getting taxed. Then, as you always know, the advanced tax jurisdictions like Europe and US in the past till now, they are always supporting the residence taxation. That means they always would like to leave minimum taxing rights to the source country and have maximum taxing rights for themselves. That would go well if at all the transactions are happening between Germany and France or Italy. Now Italy is in a very bad shape. I'm just giving the example. France and Germany, that would go well because the cross-border trade and commerce between those two countries would almost be on the same level, because both are advanced countries, both are developed countries. So you will have cross-border investments almost on the same level. Thereby, even though you have more of taxing rights with respect to your corporations, not taxed in France, that is the Germany, same way France corporations would not be taxed in Germany, German corporations would not be taxed in France, and thereby they would not lose out. But whereas when you have US or Germany and India, Germany is a very developed country, and India, we still claim ourselves to be a developing country. It will always be a one-way traffic, because I am not going to invest in that. I'm talking about the past. Now India is an outbound investing country in a big way. It's one of the major growing economies. In the past, when we are investing outside, our investment outside is very, very frugal, very little. We are always inviting investments, inviting technology into our country. So when there is a treaty between developed country and a developing country, always the investments and technology will flow from developed country to the developing country. Thereby, if at all you go on the residence-based taxation, the source country, that is the developing country, will always be a loser. That is the reason United Nations model said nothing doing. All these developing countries' rights must be protected. That is the reason India has been vociferously fighting the source rule, stating that whenever I pay anything, let it be royalty, let it be interest, let it be a dividend, let it be anything from India to a non-resident outside, I will deduct taxes. I have to tax that every payment. That is called the source rule, which we strongly canvass. The same source rule now is coming to the rescue of even large countries and advanced countries, which we will discuss. And now, in the past, residence-based taxation means all these advanced economies like Germany, France, Italy, Norway, and all this in the European Union and UK and USA. And developing countries support the source-based taxation like India and the other developing countries. But now, in the context of digitalized businesses, even European countries now, they are singing the source rule because they're all losing out. We have seen number of news items from last 4 or 5 years, whereas countries like UK, France, Germany, they are making hue and cry that these corporations are doing huge business. They're not paying any taxes in those countries also, and they are telling they must pay tax here because they are having the user base in this country. Thereby, even advanced countries in the European Union are now singing the source rule like India. So there, only Big Brother, that is the USA, still sings the residence rule because 9 out of 11 top techno companies are in USA, like Apple, Amazon, Facebook, Google, etc. Out of 11 large techno, giants, 9 are in US. Okay, US still insists that the residence rule must be followed, otherwise they are losing out. That is what their impression is. That is where the Big Brother has not signed the MLI, though it has participated in all the discussions from last 7 years. They have not signed the multilateral instrument. They said we have all the required anti-avoidance measures with us, so we will take care of the anti-avoidance measures, they say. And now also this digital taxation, and they have a different view from the entire 137 countries on one side and USA on one side. It's a very interesting times in the international tax, most exciting times of international tax. Let us see what is being done now. So in this context, what is happening, because 2015 October, when the digitalized economy taxation is not finalized, they didn't come out with any specific rules to tax the digitalized companies. Countries like India and many countries in this Italy, Austria, Slovakia, France, Belgium, Hungary, UK, all these countries have come out to tax companies like Google, like Amazon, like Facebook. And they have given different names to this. India also started by implementing Equalization Levy in 2016. Equalization Levy is a levy suggested by the Action Plan 1 in 2015 as a broad measure, but they said it is not, it's not a final suggestion. It is only a broad suggestion, an interim suggestion to start with. But India, as you know, is always a front runner in capturing even interim measures. So all these countries have levied have started unilateral tax measures with respect to digital companies, which is not to the liking of USA. And this disparity or this difference of opinion has become so strong today. When France started, if you have seen the slide, France is telling France's YouTube tax and GAFA tax. You know, YouTube is part of Google. What is GAFA tax? G stands for Google, A stands for Apple, F stands for Facebook, and again A stands for Amazon. GAFA tax. when they have come out with 3% as a tax on gross revenues earned from France by these companies, US quickly responded so strongly, stating that if at all you continue with this taxation without arriving at a consensus, you will be slapped with trade tariffs to the tune of $2.4 billion US imports coming from French like champagne, cheese, and handbags would be visited with levies 100% tariffs, which is a great dampener for the cross-border trade. It has become a trade war. So that is what happened between US and China also. That is what is happening now today also. Ultimately, a de-escalation seems to have occurred at least temporarily during 2020 early, that is in January, World Economic Forum, where US representatives asked OECD people to finalize their rule. Till such time, they have asked all other countries to keep their unilateral measures of taxation on digital companies on hold. But India has not kept anything on hold. India has been charging. France, like country, they have kept it on hold. And now let us quickly run through the European Parliament's report on digital taxation, some of the findings of this report. At the end of these findings, and I have just captured very important observations of the report, not the entire report. I've given the source link for this report, which you can download. At the end of my observations, I have given the source link, which you can always download. It is growing exponentially. I mean, the companies, see, Google was started 20 years back. Today, the size is unimaginable. You just can't think of their results, their size. Same way, Apple, same way, Amazon. These are all the things. Amazon would have started still earlier, or Apple would have started still earlier, but the mind-boggling revenues they have. And the digital businesses have tendency towards monopolization to increase their scale without mass. Scale without mass is a coin that means without your physical presence, your volume of business can be increased in a particular country to a very, very high level. And this type of business, digital businesses have got a unique advantage. They are contestable by innovative young entrepreneurs at any time. And anytime anyone can exit and come in. All the startups, we have the unicorn startups like Flipkart. Why did Walmart buy Flipkart? Though Flipkart was incurring huge losses continuously, why it was purchased at 16 billion valuation, if I'm not wrong? Why? Because the infrastructure, the IP they developed to run the e-commerce platform has been very strong. That's the reason they gave a huge valuation, and Walmart has purchased the substantive share of Flipkart. Okay, the main tax challenges of the digital economy is the lack of nexus. How to prove the nexus? What is a nexus rule? Nexus rule all through is the physical presence. Now there is no physical presence. How do you extend? Then the nexus rule must be redefined now. And reliance on intangibles. What are the intangibles? You have algorithms and softwares which are very, very advanced and which are making them earn huge revenues. And the user-generated content, Google and Facebook, this user base across the world is mind-boggling. The data they have is unimaginable. You don't know how much data they have in respect of each and every individual in every country, whoever is using. Okay, so again, the income characterization. Suppose they give one of their cloud computing service to your corporation, whether that service has to be treated as a royalty or a business income. That is a characterizer. Unless it is characterized properly, international tax rules cannot be applied effectively. And where the value is created, we are not able to know. Whether the value is getting created in India, where you have large users, say 20 crore users are there in India of Facebook. Let us say, I'm giving a very vague example, I'm not sure of the numbers. Is that the value driver of the revenues being generated by Facebook? Is that the value driver for Google? Is that the value driver for Amazon? We do not know, because Amazon has also got artificial intelligence related software like Alexa and all that. So how it is being created, where it is being created? Now it's a big challenge even for indirect tax, where the destination tax has to be levied. It remains unclear whether there is a consensus at the OECD level. There was also a discussion whether can we ring fence the digital economy. That means like Google like companies can be ring fence. Then you will be committing a blunder, because it is not only Google that is using the digitalization. Even Ford is using an automotive chain. Even a pharma companies they are using. Even other engineering companies they are using. Then how can you say they are not into digitalized economy? Virtually today, across the board, all businesses are getting digitalized. That is the rule of the law. And, and the lack of consensus on value creation leads to a multitude of profit allocation which somewhat diverge from the arm's length principle. What is the arm's length principle? Sorry, 1 minute. What is the arm's length principle? Arm's length principle is we follow in the transfer pricing regulations. When two associated enterprises, one in US and one in India, that is the group companies belonging to the same group, deal with a particular project or a contract, how to divide the profit between the two? That is the functions, assets, and risks. How do you apportion the income to each one? It is all dependent on the functions, assets, and risks. And this FAR analysis is not effective to capture this digitalized companies for the purpose of taxation. There, the arm's length principle is failing, because today they can always demonstrate all the functions are happening in US and other countries, not in India. It is only the users that are availing the the service or the app or the software. Then you will always be told that there is no function of the Google happening in India with respect to the user database. So that is the reason arm's length principle, which is the cornerstone of transfer pricing regulation, is not able to capture the correct taxing principle in respect of digitalized businesses. Just I will go back one slide. This I have completed, and then the possible scenarios for taxing the digital economy could be withholding taxes. I will just withhold what all payments that are happening from India. Is that correct? Are you doing like that? Suppose you are exporting your goods to a country on a principal to principal basis, which is not charged to tax in that country. You don't have a branch there. You export from India to say UK or Germany. That is called export of goods on a principal to principal basis, which are not charged in that country. Same way, if Germany is exporting some engineering goods to you, they are not being taxed here unless German company opens an office here and also does a lot of activity in India. Then they will have a permanent establishment, then they will be taxed. Otherwise, on a principal to principal basis, it is not to be taxed. So withholding taxes you can't apply on a principal to principal sale of services. How can you apply? Are you breaking the old rule? Then there is a controversy. Then radically changing the tax system by adopting a destination-based tax. What is destination-based? I'm just using, I'm a consumer. That is again an indirect tax principle. How do you apply indirect taxes? Indirect taxes, anyhow they will apply that principle. How can you apply that even for direct taxes? If it is so, how effective it is, how foolproof it is. These are all the various options that are under consideration, and a heavy brainstorming is happening today to arrive at the solution. A formulary apportion. See, in the transfer pricing regulations, arm's length principle is based on the FAR analysis. That is functions, assets, and risks being carried out by entities in both the jurisdictions. Whereas formulary apportionment is what they will do. They will take, suppose US company has not only got Indian subsidiary, they have got subsidiaries in Europe also. They take the entire profit, global profit, and they will try to apportion to each country on the basis of a particular formula. But that is not accepted till now largely by the international tax community. But US follows formulary apportionment within their states. They have got around 52 or 54 states, I'm not sure. Each state has got its own income tax, and there is a federal tax. There is also a municipal tax. There are three-layer income tax in USA. So when they have transaction between two interstates, that is between Pennsylvania and say another state, Virginia, and they will have this formulary apportionment they follow. It goes well within a country, but it may not go well within independent countries. Intra states within country, it is fine, but not between two sovereign states. That is the reason formulary apportionment has not been accepted so far. These are all various options. And then, as early as March 2020, they have come out with some new report stating that the taxable presence uh, can be changed by these corporations by moving quickly their intangibles, because the entire strength of these corporations is the intangible. What is the algorithm, software, and this can be moved from one jurisdiction to the other jurisdiction very easily, and then they will say our value creation is not here and it is somewhere else. And then difficulty arises where the software and algorithms are located and which country has got a right to tax them. This has become the biggest question today. And tax authorities subsequently find it increasingly difficult to determine correctly how to identify income generated by intangibles and how such income is to be allocated amongst different entities located in different countries. Suppose Google had got offices across the world. How do you apportion this income based on the intangible use? Highly digitalized businesses rely heavily on the use of data and user generated content. This leads to a situation where it is difficult to determine how far and to what extent these users who allow platforms to use their data. See, users are not paying 1 rupee to Google or Facebook. They're allowing their personal data to be used. See, today, Google has got the behavioral data of various countries. That means in India, how we as Indians behave. In China, how they behave. In Russia, how they behave. They have got the data with them. Depending on that, they create artificial intelligence packages now. That is now the core strength of Google is today. Now they are getting into artificial intelligence in a big way. So the data that you exchange, how to use their apps, their software without paying 1 rupee, you are allowing them to take your data. That is what is happening. This is like a barter system that is happening. There is no tax payment, and there is no payment of any fee by you for using those softwares. But the entire data, what you are allowing them to use, is being used for a different purpose where they are getting huge advertisements. And the digital economy has increased the complexity, the characterization. I told you, the characterization again is a big thing. Suppose Google is allowing one of their cloud computing services to you. You are a large business house in India. Infrastructure amount, a business income, it is under discussion today among the international tax experts. The sheer diversity of the digital businesses and digital businesses using multiple business lines are further tax challenges which shall be added to the robust measures that would last in face of the rapid digital evolution. And today, and in January 20, OECD G20 framework issued a statement that is as back as January 31st. They have given the latest report of their work, how they are progressing, and what their agenda is, how to arrive at a consensus taxing principle by end of 2020. It is a very ambitious agenda because with a lot of resistance from USA, big brother, how far we will be successful, how far we'll come out with a new taxing right is a billion-dollar question, and more so in this COVID-19 pandemic scenario. In spite of COVID-19 pandemic scenario, all these inclusive framework countries have taken a pledge that they will advance their negotiations and their work through video conferencing and try to meet the deadline of 2020 December. Okay, and US has asked everyone to keep on hold their unilateral taxing measures of digital companies till OECD G20 inclusive framework comes out with a final proposition. So I have given the source at the end of this thing, which source you can download. And then let us quickly run through what is the journey that OECD has taken since 2015, October 5th, when they have released the action plans. The first action plan was released without concluding that. They were only broad suggestions. They hope and they are ambitious to complete their work and come out with the final taxing rule for these digitalized businesses by end of 2020. Let us see. This is the most exciting year with so many developments, whether it's good or bad. OECD's interim report on tax challenges as a follow-up has come in March 2018. And then addressing the tax challenges of the digitalization, again, further policy note has come in January 2019. And they have also given a program of work in May 2000. These are all the milestones they are recording in the process of reaching the final goal. And way back October 2019, they have given a proposal which is called a unified approach. Unified approach, what they are telling broadly for your understanding, what they are telling, a new taxing right would be given to the country of market. Now they are calling it country of market, not country of source. Country of market, where physical presence need not be there. Suppose a particular huge revenue is getting generated, say beyond 750 million euros, would get translated into Indian rupees to the tune of 5,700 crores. If that is happening, then probably you will have a taxing right, and what you will be given again is dependent on the formula that could be decided now. So this unified approach has broadly given 3 proposals to deal with this new taxing right. One is the user participation. Entire Europe is based on this concept called user participation. Suppose you are Google or Facebook, you have so many users here that itself is an excess that gives us a right to tax. That is their slogan. Then marketing intangibles. US says US is dependent on marketing intangibles. Marketing intangible is a concept. For the first time, it came up 12 years or 13 years back when Glaxo, one of the leading pharma companies of UK, which sells drugs across the world, when it has sold a particular drug in huge volumes in US, then US IRS means US revenue authorities, they have come out with a new argument. You have developed a particular marketing intangible in US for your product by canvassing in a big way, publicizing in a big way. So thereby this intangible that is created in US has given you super profits on this drug in the US sales. So you need to extra compensate and bring extra profits to tax in US on the basis of marketing intangibles. There is a concept which is very, very popular concept in transfer pricing today. That is on which we have got the Maruti Suzuki's case by the Delhi High Court, which is pending before the Supreme Court now. The same concept has been applied in the transfer pricing assessments of Maruti Suzuki in India. And significant, they say USA, you follow the marketing intangible. That means unless you have super profits, being generated in a particular country, you will not have a taxing right. They want to restrict the taxing right of their technogens in the other countries. Probably that is the concept they have. They want to go by the old rule and the arm's length principle. And so thereby they are not accepting the new rule. And the significant economic presence is a concept. India is always unique, always, whether it is 30 years back, 40 years back, or today. Today, India is highly respected by OECD because what all India has been canvassing has come true today. India says, if at all there is a source in my country, if at all I am paying non-resident a particular amount, which is going to his as a revenue, that should get taxed in India. That is the source principle India has been canvassing. The same source principle, now everyone is relying to capture this particular revenues of large digital companies for taxation in their country. The entire European Union now is siding or supporting the source principle along with India. These are the most exciting times in international tax. And these proposals would entail solutions that go beyond ALP, means the arm's length principle. India never accepted the FAIR analysis, especially with respect to attribution of profits to permanent establishment or branch, because the FAIR analysis is lopsided. It always favors more of resident country than the source country. That is the strong impression India had. Okay, now let us quickly, these proposals would entail solutions that go beyond the ALP. Pillar 2 is published November 19 on anti-awards, which I am not discussing. Pillar 1, there are two pillars which they have released. That is, Pillar 1 deals with digital taxation, that is the taxation of the digitalized economy, and Pillar 2, that is called GLOBE, that is the how anti-avoidance measures must be tightened further. That we are not discussing. That has nothing to do with the digital taxation. And three alternatives have significant commonalities. What are the three alternatives suggested by the unified approach? User participation could be a nexus rule. Marketing intangibles could be a nexus rule, or significant economic presence. It is not a physical presence, but economic presence. Suppose Google records 6,000 crore turnover from India. I will say there is a nexus here, so you have to pay tax here. So now how we go about these three proposals have got some common features which say reallocate taxing rights in favor of the user or the market jurisdiction. Everyone is now say you give it to the market jurisdiction a new taxing right. All the proposals tend to say a new nexus rule that would not depend on the physical presence. No physical presence is required to exercise this taxing right. It's a virtual presence. Then also you will be liable to tax here, provided you have a nexus. How you create a nexus? By achieving a substantial turnover from this market. Probably that would be a nexus. And they all go beyond the arm's length principle. Arm's length principle would not work here for this new taxing right. They are going beyond this. They have not dumped arm's length principle. Arm's length principle will work for the existing routine profits. This will work for non-routine profit. That means profits beyond the normal. That means a higher profits or a super profits what you are earning would have to suffer from this new taxing right. So, but at the same time, the new taxing rule must be simple, easily administrable, and you must have a certainty, tax certainty in that. So quickly, having an understanding, marketing intangibles supported by US and user participation being largely supported by the European Union, they go under the principle, you only charge portion of non-routine profit. What is non-routine profit? When Glaxo has earned super profits in US against one of their drugs 12, 13 years back, they have taken that part of that super profits as a marketing intangible profit in US for taxation. They say you go under the same principle. Non-routine profits shall be identified and then should be brought to tax in a particular formula. How difficult it is, you just see. significant economic presence. India says profit, all profits. Let it be routine or non-routine, we are not bothered. Because if you go into routine and non-routine, it becomes highly subjective. There could be a lot of litigation. So they are playing safe and telling, if you cross a particular threshold of turnover, you will have to pay tax in the market jurisdiction. That is the Indian slogan. And now the unified approach, which is announced by OECD in October 2019, and which is further refined in January 31st of 2020, has got a three-tier taxing mechanism. What is that? They are telling MNEs means multinational enterprises who are spread across countries, large companies like Google, like Facebook, it could be any company, large company. Consolidated group profits must, some portion of that profits must be allocated to market jurisdictions. What should be allocated? Share of deemed residual profit. Residual profit means non-routine profit, not a routine profit. Must be allocated to the market jurisdiction using a formula. How you use the formula, we will come to that. Amount B, a fixed remuneration for baseline marketing and distribution. This is what is already there. Amount B is not new, amount C is not new. Amount A only is new. Amount B says, you continue with your marketing and distribution functions, what you regularly do, they must get covered by the arm's length principle and the FAR analysis, that is the functions, assets, and risks. Whatever principle you are following under the ALP, arm's length standard, you follow that. Amount C is, you do over and above the distribution function, you do something else. That is what it is contested in Maruti Suzuki's case by the revenue, that what you have done, Maruti has done. Maruti Suzuki means it's a Japanese joint venture. Japanese brand name is used in India by Maruti. And what they said, revenue authorities said, you have increased your brand logo of Maruti, of Suzuki in a big way through Maruti in India. So you will have to pay tax on that extra revenues you are getting on that brand improvisation, which is done by the Indian company. So you have to pay that extra taxes. That is the concept of marketing intangibles they have used almost 7-8 years back, and also in LG. LG also it is used by the special bench of Delhi, which cases are all before the Supreme Court now. The concept, the entire marketing intangible issue is before the Supreme Court. So amount C talks about marketing intangible, binding and effective dispute prevention and resolution mechanisms relating to all elements of proposal, including additional profits where in-country functions exceed the baseline activity. What they told in Maruti's case, Indian functions have gone beyond the normal distributor's functions. They have done much beyond the normal distributor what he does. They have done extra functions of branding the Suzuki in India in a big way. So thereby the marketing intangible is created. So that extra functions need to be compensated, and those profits need to be extra taxed in India. So that amount C is also should be governed by arm's length principle only, and an effective dispute resolution system must be in place. So amount A is now the target, share of profits which should get taxed in the market jurisdictions. Pankaj, what time should I wind up, Pankaj? Or,
Yeah, Prasad, you just take your time, not a problem, because it's a different topic, so exactly. I don't want you to rush or do anything.
Yes, because I want to go by the audience comfort, and I want to ensure that the essence goes deep into their mind and effectively. That is my objective. Okay.
I understand, Prasad. See, there are two things. One is when you're doing a live, the eyes will shows everything. Correct. But in a virtual presentation, I promise you one thing. You can also see it. The non-leaving of audience itself shows that they are interested. So people who are here. So more than about 200 people are there with us. They are continuously here. Only one request now that we are done is, sometimes what is happening is when you are speaking, sometimes the voice is breaking or it's becoming jarring. So just take care of that. But from my side, Prasad, please go ahead. Okay. It would be.
So I'm able to see only my eyes. I'm not able to see the eyes of the audience. That is,
I'm taking care of that. Just go ahead.
Thank you. Thank you. OECD G20 inclusive framework on website, two-pillar approach has been, again, they have modified that what they have given in October, what they said. They are giving timelines and they are telling we will stick to our timelines of achieving the consensus by December 2020, and we will come out with our major report by July 20. That is what is they're telling, and that would be the the agenda what they have before OECD G20 and inclusive framework. And what they have done, see, when they're trying to apply this new taxing right against deemed residual profit generated by global companies in the market jurisdiction, they are trying to categorize and apply this on consumer facing businesses. Basically, this concept started with the user participation model, what European Union told. That means you have an interface with the customers directly. You have a consumer facing business, which you are doing virtually, not physically, through digital means. So these consumer facing businesses should all come under the ambit of the new taxing right, is the original proposition. Then they have refined that in the statement what they have released on 31st January. What they told, we will categorize this into two. Automated digital services is one important group in the category. The other group would be consumer facing businesses. What is consumer? Suppose if it is a business to business, there is no consumer involved, then that would not get covered for the purpose of new taxing right. Please remember, they are trying to go directly business to consumer. That is, consumer facing businesses should all come under taxation for the purpose of this new taxing rule. Extractive industries. What are extractive industries? Like mining industries, mining industry. Because they don't interact with the customers directly. No, never. They, whatever mineral they pick out, that becomes raw material for some other industry, and that industry would ultimately bring out their end product and all. Same way, that is not a, like a mineral industry should go. Then there is also a representation by the stakeholders in November after October, when they have released the the original unified approach proposal public document in October. There are many representations that have come up, wherein the financial services industry said, keep us out of this new tax, because all our revenues would be earned from the customers directly in a physical manner, even though it is in a virtual manner. The respective markets are allowed to tax our profits already. So thereby, our physical presence is always there in one way or other. So International Banking Association, there is a lobbying association which lobbied before OECD. They said entire financial services should go out of the ambit of the new taxing rule. So that is being actively considered in favor of them, because they say all our that residual profits are always being taxed in the market, respective market jurisdiction. There is no grievance. And then they are also trying to come out with the threshold, how it should apply. It should apply like 750 million euro revenue that particular country should have recorded. Suppose Google should have recorded this particular revenue in this country, like 5,500 or 5,600 crores in Indian rupees, subject to exchange fluctuation, say up to 6,000 crore. Then you will have the basic taxing rate. Otherwise, if it is less than that, there is no taxing rate. And in scope revenue threshold, even after that 6,000 crore, there can be internal thresholds again with respect to sub activities. All that we need to wait and see what is the ultimate formula they are going to come out. And de minimis carve out. That is, de minimis carve out means if at all the profit after applying and all that the formula, if at all it is less than a particular threshold again, then it should not be subject to tax. See, when you go to this equalization levy, which is proposed in 165A, they said up to 2 crores, the e-commerce, non-resident e-commerce operator need not pay any tax. That is also a digital tax, which we will discuss in the Indian scenario, which we are coming now. So, a de minimis carve out also is being under consideration. This amount A has to consider not all global profits can be taken as it is because the use of business line, regional segmentation. See, the amount of profits I can make in Asia are different from the amount of profits I can make in Europe. The amount of profits I can make in Africa might be still lesser. So you can't compare these regions on a parallel, on an equal basis. No, you must give necessary adjustment to the respective regional attributes. That is for the each continent or each region. And then notion of digital differentiation. And at what level the digitalized business is operating. That could be one of the factors for a proper adjustment. Otherwise, you can't apply this as a thumb rule across all industries, across all companies. Specific revenue sourcing rules for different business models. The business models are different. How much complicated it is, you see. How can we arrive at a long-lasting taxing rule which should stand the test of scrutiny? It is very, very difficult. And the outline identifies profit before tax as the most favorable profit level. And one more thing, each country follows its own accounting standards. There is a better person to talk about that. See, we have Indian GAAP is different, US GAAP is different, and whether you make adjustments for the global profits in the respective country to bring it to your level of profit by applying your Indian GAAP. If you start doing that, you will stand nowhere. KPMG, like large, all the big four, they have already represented that no accounting adjustments must be done for the global group profits, and work to determine how to avoid double counting. There could be an overlap between amount A, which is a new income being captured for a new taxing rate. That income would have already been captured in amount C, where you have extra functions and you have a fair analysis. We do not know because amount A is not following a fair analysis. It is following a formulaic approach, whereas amount C follows arm's length principle. There could be an overlap. If there is an overlap, no income should be taxed twice. There should not be a double taxation. So there should not be a double count. What is a double count? The profit is counted under amount A and also under amount C, which is wrong. You can't do that. So you must ensure that there is no double tax and no double count. And regarding amount B, the outline notes see amount B, what it talks about? It talks about the baseline distribution and marketing function. There they are trying to give a fixed percentage like your presumptive income tax, 44 AD, 8%. Like that, they are prescribing some particular ratio of ratio as a profit for the sake of an easy assessment. For the sake of an easy assessment. Again, they are telling you can't prescribe fixed ratios as profit ratios because it changes from business to business. Sometimes the functions change. All that hue and cry is again being made. They will need to account for regional, industry, and functionality differences. You must give adjustments, otherwise your formula will fail. A definition of the baseline activities is nothing but a routine functions what you carry. So this is where they are trying to bring in effective dispute resolution also. So now we have amount A talking about the new taxing rule with respect to deemed non-routine profit. That is a non-routine, that is a super profit. Then you have amount B, which is already in existence as per the arm's length principle for distribution and marketing functions in the source country, which is now known as a marketing country. And amount C is extra functions they carry out, like in the case of Maruti Suzuki, where distributors have acted beyond their mandate and they have taken extra function to develop the intangible in India. So where revenue authorities claimed extra tax for taxation in India, extra income for taxation in India. So now a very effective dispute resolution must be there when you are putting this new rule, because this is a highly subjective formula, what you are trying to bring in, how this formula works, how subjective it would be, how litigated, you have to wait and see. The outline emphasizes that commitment to implementing Pillar 1 will require countries to withdraw unilateral measures. What all unilateral measures I have shown in the original slides, everyone is now undertaking, assuring that they will withdraw, provided they come to a consensus and everyone accepts this new taxing law. Then we also have to withdraw the equalization levy, which we have started in 2016 and expanded now. And now the pledge is by July 2020, they must arrive at the, the taxing principle in a broad manner. And by 2020 December, they should have finalized this. See, whether it should be taxed on net income or gross income. See, what the formula they are suggesting in the unified approach is profits. Profits means net income. Profit before tax. But now, some suggestions from some stakeholders, they are telling, don't go under net income, because net income calculation is a big problem. And because so many accounting issues would come up, so many adjustments would come up, and it would be subject to a lot of litigation and all that. They are suggesting a gross income taxation like royalty. Today, how royalties are taxed? Suppose you are paying $1 lakh as royalty from India, you will charge 10% under 115A along with education cess and surcharge. So there is no problem whether this royalty is resulting in a profit or loss. You are least bothered. You are going to charge on the basis of the gross basis. That is what someone is suggesting, which is a better option. We do not know. The better approach is to use gross basis taxes. Is one of the potential and very sound suggestion made to OECD. And these are all the challenges. You can go through this. I'm not going to spend time on this. These are all big challenges you have to face if you have to apply this new formula to arrive at the deemed residual profit of a global corporation at the global level. And then apply the formula, the ratio, that is the allocation key, to arrive what is to be apportioned to marketing jurisdictions all. Suppose there are 200 markets, you will have to apportion that amount to all the 200 markets. You can't apportion in a same manner. Again, it depends on what is the nexus and how much revenue you have generated, and so many other attributes need to be looked into. Then we have applicability to certain business models. So take the Facebook model. Much of the content posted on the Facebook is generated from the data given by the customers who are in countries where Facebook may have little physical presence. They don't have physical presence. Without customer generated content, Facebook business model is not successful. Because they are getting all the users from various countries, they are getting the data. Because they have so much of user base across countries, other business corporations are giving huge advertisements to them, and that is the main revenue for Facebook. So there, have you to come to an understanding that the data from this user, is it really adding value or not? Facebook could not sell ads or gather user data that has value to produce their revenue. That single fact seems to serve to justify that the market jurisdictions means where users are located, that country has a right to tax you, provided you have particular number of users in that country. Not all companies have similar business models, hence the methodology of digital taxation for them is to be analyzed separately. And now, whether concept of digital taxation applicable to the pharma companies, just is another. IP is a cornerstone of the pharmaceutical industry, and manufacturing a particular pill is a prominent example of business that can achieve scale without mass. Drug prices differ dramatically from country to country. In the US, there are no price controls, and you can whatever price you can put in the market as per demand supply, you can put it. Unlike many countries, even like India, where you have price controls on some drugs. Can you compare profits generated by the same drug in both the countries and say that US is generating super profit because there is no price control there, and the other countries, the profit is not high? Because of the price control, what is happening? Can you arrive at can you infer that there is a super profit in the US and try to allocate that profit to other jurisdictions? No. Under the OECD proposal, would that be ignored with a portion of a drug company's global profits allocated to countries where price controls effectively eliminate most, if not all, the net income? Under OECD proposal, revenue and net income from so-and-so will likely to be reallocated at least in part to low margin countries. From high margin, it goes to low margin some part. High margin countries will resist this reallocation, stating that they have no right to take this profit. That would be a dispute. The same problem arises in transfer pricing. The global rules require that country-specific markups and profit margins be respected. That is the reason new taxing rate is not going as per the arm's length principle. It wants to go beyond the arm's length. Now you can understand, US is supporting the second bullet, and the first bullet is being supported by the entire world except US. Except US, everyone else is telling that the super profits of your company resident of US must be allocated to all the countries. And US is telling, no, go by the world principle. As per the transfer pricing, FAR analysis, all functions are carried out in the US. So will collect taxes only there and not give you taxes. If there is any marketing intangible that is created in your country by special efforts, then definitely you can claim extra, otherwise not. This is the sum and substance you can understand broadly for your comfort. And see, the US Treasury told, see, Big Brother has been part of all these deliberations from last 10 years in the OECD. OECD is congregation of tax gatherers in Europe. That means all advanced tax jurisdictions are members. And the US Big Brother funds OECD in a big way. US has been observing everything what is going on. And when MLI has to be signed on June 7th of 2017, the US did not sign MLI. They said, no, we are not signing. We have what all anti-avoidance provisions you want to bring in MLI are already there in our domestic law, which is a very strong law we have. We can deal with any sort of anti-abuse position or anti-avoidance position. So we need not have to sign MLI. So today, India-US tax treaty is not impacted by MLI because USA did not sign MLI, though India has signed. Okay. And then US Treasury is telling today on 3rd December, after going through this Secretariat proposal of OECD, which we have discussed now, unified approach, they said, what all you are proposing can be treated as a safe harbor at the most. What is a safe harbor? Today, under the transfer pricing rules, you have safe harbor margins. Suppose you are in software industry. Suppose you are into R&D. Suppose you are into pharma. You have certain ratios given. It is like a presumptive income taxation. Suppose you are declaring 20% or 22% as a software development service model, or even 25%. I don't remember the margins because no one in India is using the software safe harbor route because these safe harbor margins are very high, unrealistic. It is only an option. Suppose I am not ready to offer 25% as my margin for a software development outsourced company here in India, whereas I'm hardly earning 15 to 16%, I will go with regular documentation. I'll prepare the TP study. I'll file my taxes. I'll fight my case and I'll prove that I have earned only 16% and not more than that. But I have an option. Suppose in a particular year, I have earned almost 22%, 23%, 24%. Then I don't mind going under the safe harbor and say 25%. I will declare so that you should not give it. What is the advantage of safe harbor? You will not be scrutinized. There will not be any scrutiny. That is the advantage. But safe harbor always is an option. US is coolly telling what all you are proposing for digital taxation, take it as a safe harbor that we are ready, not beyond. Safe harbor is only an option. It is not a mandatory taxing right. It is at the option of the taxpayer. So no taxpayer will opt for safe harbor. They will all go under the existing rule. That would totally undo the entire effort at a OECD G20 Inclusive Framework Initiative. So with which OECD has quickly replied on 4th of December, no, you are not acceptable for the safe harbor proposition, what you are telling. That is how it now it's a loggerheads now. And now the entire discussion of this unified approach still is not yet finalized. They are refining that scope. Scope means overall getting covered under the new taxing right of digitalized economy. What is the nexus? How do you create the nexus? Is it the sales volume, or is it the user base, or is it the marketing intangible? We do not know. Significant economic presence talks about sales, that is India. And marketing intangibles talks about you must establish that a new intangible is created in your market, then you will have a right to tax. That is the US approach. User base, Europe says it is not revenue. Suppose I have 1 lakh users in a particular country, that is good enough for me to tax. So what would be the nexus rule? There is a debate going on, what difference between nexus and source. There's a research is going on, I'm part of that. And there's a big theory which we are doing in ITRAF now, International Tax Research Analysis and Foundation. That is being chaired by Dr. Shom, Prasad Shom. And new profit allocation rule going beyond ALP. New profit allocation rule going beyond the ALP, complemented by formula-based solutions. That means this new rule, what is being proposed, that is not going as per the Armstrong principle, it will go as per a formulaic approach. And increased tax certainty delivered via 3-tier mechanism is what OECD is claiming. Then quickly come to the Indian scenario. We have introduction of Equalization Levy, online advertising and extended Equalization Levy 2020 has come. New nexus rule, significant economic presence, we have already brought into section 9, but it is not made effective. That has been postponed to 21-22. So for the simple reason, we are part of OECD G20 BEPS agenda. So we are also waiting for the final consensus rule to come out. Introduction of withholding tax on e-commerce transaction, that is 194O, which we have come. E-commerce operator has to deduct taxes before paying it to the e-commerce participant who is a seller, which has been brought in by Finance Act 2020. And proposed Rule 10 attribution. We have a Rule 10 which talks about attribution of profits to a permanent establishment in India. Suppose a foreign company has got a branch in India, how the branch profits has to be quantified. This particular rule, which was developed way back when the Income Tax Act was born, needs a lot of improvement in line with so much of judicial development and also the business model development. That is the reason CBDT has come out with new proposed Rule 10 for attribution, which should also be known because they're also talking about the country of market and all that. So these are all the developments happening on the Indian side. We are a very active participant in the 137 inclusive framework, and our word is highly valued today. And Finance Act 2016 has brought the Equalization Levy. When 2015 Action Plan 1 report, which is not concluded, where they said broadly that the equalization levy could be one of the options that could be taken up as a measure by the domestic tax jurisdiction. They immediately, India jumped at it and brought equalization levy in 2016 Finance Act. Currently, an equalization levy is levied at the rate of 6% on specified revenues received, specified services received from a non-resident. Currently, the term specified services include online advertisement and provision for digital advertising space or any other facility or service for the purpose of online advertising. This is mainly to target Google-like companies who provide advertising space to so many corporates who avail that in India. What is happening? Because the small corporate who's availing advertising space on the Google, can they insist that suppose they are paying $1 lakh as the fee to Google, can they deduct the 6%? That is what is supposed to be done. But what they say, we don't know what you do. You just pay us 1 lakh net. Then what is happening? The 6% is becoming an additional cost for the Indian taxpayer who is availing this online advertisement service from Google-like company. Because we don't have that much of bargaining capacity, and thereby the 6% is falling on them. That is the reason now 165A, the obligation is cast on the non-resident e-commerce operator himself and not on the Indian payers. So here the 165, this is under the Finance Act, not under the income tax law. Equalization levy is not part of the income tax law. It is not part of the Indian treaty network. It is beyond that. We do not know what type of tax it is. That is it is called a levy. It is neither income tax, it is neither indirect tax. We do not know what it is. There is a lot of hue and cry stating that whatever amounts non-residents are going to suffer, if at all they allow 6% to be deducted against their payment, that 6% they are not going to get as a tax credit in their jurisdiction. This is not covered by tax treaties. This is not covered by the domestic tax laws. The levy is to be collected and deposited by the payer who is receiving the specified service. This is already there in the law. What is now added? Extended equalization levy. Finance Act 2020 has now introduced a new provision to enhance the scope of equalization levy. Equalization levy will now be extended to e-commerce, non-resident e-commerce operator for e-commerce supply of goods and services, both undertaken on or after 1st April 2020. An e-commerce operator has been defined to mean a non-resident who operates or manages a digital or an electronic facility or a platform. It could be an Amazon. It cannot be a Flipkart, because Flipkart is a resident of this country or resident of Singapore, I do not know, but Flipkart operations now are mostly resident, that is what I feel. It mandates equalization levy at the rate of 2% on the sum received or receivable by an e-commerce operator. See how a platform operates, e-commerce platform. It is a platform where buyers and sellers come together. E-commerce operator is like a company like Amazon, will enable both buyers and sellers to come to this e-commerce platform and make the online sales. Okay. So that is the reason the infrastructure is facilitated by Amazon-like company or a Flipkart-like company. Okay, so it mandates equalization levy, and this seller is called a participant and buyer is also a participant. If seller is a participant, how the seller's money would suffer, that 194 we will see. It mandates equalization levy at the rate of 2% on the sum received or receivable by an e-commerce operator from e-commerce supply of goods or services made or provided. However, there are some exceptions. If the e-commerce operator is already having a permanent establishment in India, this will get covered by the permanent establishment and the normal tax would apply. So in that case, this levy would not apply. Equalization levy on section 1, if at all this service is already covered by the earlier 165, that is the existing equalization levy, then it would not get covered under the new levy coming under 165 capital A. If the sale turnover or gross receipt is less than 2 crore during the previous year. There is a debate whether this 2 crore is with respect to each payee or is with respect to all payees put together. Because, sorry, not payee, it is payer. All payers put together. Payee is the e-commerce operator. Whether 2 crores threshold would apply in respect of each payer who is a resident here, or is the 2 crore threshold will be aggregated against all the payers. That is, there is no clarity on that. And similar to liabilities of the equalization levy, as previously imposed, this expanded levy would not form part of income tax, and it is not part of treaty network, which I have mentioned. And liability to pay equalization levy on the non-resident e-commerce operator. It is on the e-commerce operator who has to comply with the law. He has to pay this 2%, and resident payer has no obligation to deduct like the earlier levy. That is the online advertisement thing. And payment to be made on a quarterly basis by e-commerce operator, non-resident e-commerce operator himself. Interest at the rate of 1% is payable if there is a delay in payment, and penalty equal to the amount of levy payable for default in payment. And even business connection under Section 9 has been expanded. Transaction in respect of goods, services, property of the NR in India, including provision of downloaded data or software in India for aggregate of payments during the year, exceed the prescribed amount. That is under the significant economic presence. We are trying to bring this rules or these characteristics. Systemic and continuous soliciting of business in India by digital means is also an economic presence here. Engaging in interaction with prescribed number of users in India is also an economic presence here as per our Section 9 significant economic presence. But anyhow, it's going to come into effect only from 22-23 assessment year. And in the Finance Act 2020, we have expanded the source rule of this significant economic presence, stating that income attributable to operations carried out in India shall include advertisements which target customers in India, sale of data collected from a person who resides in India, or from a person who is using IP address, Internet Protocol address located in India, sale of goods using the above data that collected from a person who resides in India or who is using an IP address located in India. And quickly, 194 also has come into the statute book. What it says, 194 is totally different. What it says, e-commerce operator now, we talked about what he has to pay under equalization. This is, he's not paying, he is acting as a deductor, that's all. As I told you, the platform enables both buyers and sellers who are participants to come and complete their deal. So what 194 says is, when operator collects amount from buyers and passes the same amount to sellers, they will have to deduct 1% on the sale of goods and also services. And this is what they have prescribed. And if at all there is no PAN for the participant who is a seller, the deduction will go up to 5%, not 1%. If he has a PAN, it will be only 1%. TDS obligation on e-commerce operator in respect of the payments to be made to the payer, that he would become a deemed deductor. TDS not to apply where gross proceeds are less than 5 lakhs, then it need not be applied. That is what is 194A. But when we talk about 194A, we should bear in mind, if at all I am selling my goods in a physical shop and not through e-commerce online sale, is there any tax deduction happening? Suppose someone comes and buys my goods, is there any tax deduction? No. But if I'm selling through e-commerce operator on the e-commerce platform, I'm suffering 1% deduction. This is unfair. This is not on a level playing field, which has been opposed by all the associations. I think Institute also opposed this in the post-budget memorandum, but that has not been heeded to. Difficulties in collection of TDS. Sometimes what happens, the buyer would directly pay to the seller, though they are participating in the e-commerce platform. Then how can e-commerce operator comply with the TDS obligation? And whether cancellation charges also attracts you. Sometimes the deals are cancelled. You buy a particular product, there is always a seller approval clause. Suppose you are not satisfied with the quality, you can return within a particular period of time, say 15 days or 1 month. Suppose you return, the sale is cancelled, then how do you go ahead with this amount what is already deducted? How do you undo that? sales returns and discounts, how you carry out sales returns and discount, and with respect to this TDS obligation, how do you attend to those issues. We have come to the final module, which will take another just 5 minutes or maximum 5 to 7 minutes. We are coming, the CBDT has come out. Is it okay, Pankaj?
Yeah, fine, Prasad. Just wanted to tell you there are 20 questions also which have already come.
So I will complete in 5 minutes. Okay.
Yeah, please.
So CBDT draft report, what they say, see, India has always been canvassing that if at all I am a market, the market jurisdiction must be rewarded for taxing income that is generated both by routine and non-routine profits. That is the slogan. That is the same slogan which is being brought under significant economic presence by India-like countries also. The same concept has come in this draft report, which is not yet finalized. Even this has been kept on hold. This was released in April 2019 for the discussion by the stakeholders, but it is a very well drafted report by CBDT, which has bearing on the present day's discussion on digital taxation. Existing profit attribution rule, which was there under the earlier Rule 10, is not effective because it is working on an ad hoc manner. It's on a guesswork manner, which many courts have said that Rule 10 is not a scientific basis. Need for clarity in India's approach on PE attribution is required, and significant economic presence as a nexus from here also. It is very clear that India is harping on significant economic presence and not on the other two proposals. And demand recognized as requirement for income generation. What they are telling in this report, as how supply is important, even demand is important. Suppose my market is giving a lot of demand to your product, I am eligible to tax you in this country. That is the new slogan. But when you will tax, that can affect you both ways. So you might tax some companies coming from outside into India. Then you will also get taxed if your products are going out to the other markets. The old principle, on a principle to principle basis, where it's not getting taxed if any products are sold, that rule is getting breached. How do you reconcile that rule, or how do you create a categorization between different transactions? Can you apply only to digital means transactions? No, this report is not talking or getting confined to digital means. It is talking about all types of transactions. And demand recognized as a requirement. And then final conclusions are, I just given broadly what are the conclusions, and emphasize that business profits are contributed by both demand and supply side, hence be allocated to market jurisdictions also. Even this report is canvassing for taxes to be paid in the market jurisdiction. Discusses different approaches of profit attribution, supply-based approach, demand-based approach, mixed and balanced approach, which is being, that mixed means attribute profits to supply side and attribute profits to demand side also. Rejects functional asset risk analysis because a fair analysis as per the OECD model 2010 is not taking care of the demand side. So India has always been against the fair analysis for attribution of profits to PE in India. Considers that the fractional apportionment method has to be adopted, and they have given their own formula, which I would suggest you go and read this formula. This is not a complicated formula. S stands for sales, N stands for number of employees, W stands for wages, and again this stands for assets. A stands for assets. So this is a formula borrowed from European Union. They have developed a formula for common consolidated corporate tax base, CCTB. You can go to the European Union website, you will get, but even that proposal is kept on hold for want of arriving at consensus by this unified approach by OECD. Even this proposal, what is made in April 2019, is still under discussion stage, but it is my duty to bring to your notice. This is also kept on hold for want of consensus that is being arrived at in the OECD BEPS initiative. Here, low and medium user intensity, if at all is user intensity products or services like Google and Facebook, they say that they will give some weights to the users also in this formula. If the low user, the formula is different. High user intensity, the formula is different. This also, I have given the source. You can download this report and then go through this. Friends, I have gone through in the limited time available how this digital tax is uh, operating, going to operate. It has not yet been finalized. What is going on, you should know. What is happening around you, you should know. And we are on a virtual, what you say, we are in a virtual world today, and you have to keep track of developments happening across the world. And gone were the days when you are insulated and bothered about what is happening only in your country, because India is one of the most emerging economies today, and it is watched and respected across the world by every country today. More so post COVID-19 pandemic. It's a very heartening news that India's image is very high, and it has to be still higher, and we all have to have great times to come. And Pankaj, you can take up the questions.
Yeah. Thank you very much, Prasad. Before I think I actually go to questions, just 1 or 2 minutes from me. I think, Prasad, the topics what you deal, I think in about 99% or more of the seminars, your parting sentence would have been, time permitting, I would have covered more. Okay. So I don't know. Someday I think we'll have to have one presentation, one full day for you only, but I know you can't. See, one is a lot of requests.
Audience are ready. I'm ready to share my knowledge.
Thank you,
Share my
Prasad.
knowledge, whatever little I have, whatever little I have.
Very kind of you, but many people are asking for presentation. In fact, one of the last chat you see, he says, I'll have to read it 2-3 times and then listen to a recording to have a proper understanding. But yes, request you to please share the presentation also so that we take.
I will send it to you. I'll send it to you.
And
so now I will close the presentation now.
Yeah. Huh? You just mail it to me, and what I will do is I'll be putting it in the Hyderabad branch website.
Okay.
Okay. As a Prasad, I'm taking the questions one by one. And if you think that I will read out for the benefit of others so that they can know. The first question came from 11:17 a.m. from CA VMV Supparao from Nellur. I think he's the person spreading the light who believes that a candle will not lose the light.
Correct.
Okay. All of us know why India will not become a member of OECD.
Achha. No, actually, OECD is a congregation of developed economies. We still don't claim ourselves to be a developed economy. We still claim the status of a developing economy. So we are not part of OECD. And one more thing is, OECD principle is residence-based taxation, giving more taxing rights to the residence countries and not to the source country. See, all through India being a developing country, we have been receiving technology and we have been receiving capital into this country. So we will be on a losing ground if at all we go and sit in the group of developed nations. So we should always protect our revenue. So we should canvass our source rule being a developing country. So hence we are not part of OECD and we are only an observer in the OECD.
Yeah. The next question is from Murli Krishna Chodavarapu.
Yes.
Why and how China is different? Is it because of the current situation or even otherwise?
Different with respect to what? I couldn't understand. Different in the sense, probably he meant whether China is a developed economy or a developing economy, or whether they support the source rule, or whether they are supporting this new taxation rule and all. They are indifferent. That is the reason, if you observe in one of the slides, we have put China is indifferent because, as you all know, subject to exact correction of the figures, next to US is a 22 trillion economy, and China is now, if I'm not wrong, it is 15 or 16 trillion economy. So they are growing in a big way, and they have outbound investments, inbound investments, and all that, and they have their own technology companies. So they are indifferent. They just want to also, they are not opposing anything. And as of now, we would say China is supporting the inclusive framework proposition also.
The next question is from Srilekha, which says that, sir, while interpreting DTAs, can all services provided be covered under Article 7 business profits? But if a company is engaged in providing technical service, should business profit be checked, or fee for technical services article needs to be checked?
So as you know, fees for technical services is an article which is canvassed by India in a big way. In the OECD Model Convention, fees for technical services article was not there even till today. I think now they are giving they are allowing the United Nations. It has come out with a article on that, Article 12A, if I am not wrong. But we always insisted that fees for technical service must be a specific article in all our treaties, including US also. With US, I'm told the treaty was negotiated for 23 long years to arrive to conclude the treaty, because India was very stubborn on some issues and in furthering the source rule. That is the reason when you render a technical service a non-resident from the other country, India would like to categorize that under the FTS article, because FTS article doesn't require your permanent establishment in India that can get taxed on gross basis along with your royalties. So that is what India wants as per the treaty. So it will get categorized under FTS. You must try to prove that it would not get covered under FTS. Then only it will go to the business profits. Otherwise, it is not at your option that you can say that you go under business profits. So you must prove that the definition under a particular treaty, the FTS is not covered. If you see the India-US tax treaty, after negotiation, they have truncated the scope of FTS. They said not every technical service would get covered under the Article 12 of Indo-US tax treaty, because they said unless the expertise behind the service is imparted to the service recipient, it would not amount to a service. If you are just utilizing the service, not getting the expertise behind that to enable yourself to apply that on your own second time, that is not to be treated as a technical service as per Indo-US make available clause. Thereby, it goes out of FTS. Then it has to be categorized as business profits. Otherwise, it is not at your option. You can simply bring it under the business article. You must be able to substantiate that it would not get covered under the FTS article of a particular treaty.
Yeah. So the next three questions, I'm reading it together because they are more or less same.
Okay.
I think two from Balaji and one from Satyanarayana P. Okay. Sir, now we users of WhatsApp and Facebook use this at no cost. If the digital taxation starts, then will they charge us on these apps? And then another person, continuing question is, I'm using this WhatsApp in India. This is accounting as Indian source. What if I go abroad and use it for few months or occasion? Where should it be accounted? And similarly, in a Zoom webinar series, who is the user? Host or the attendees?
Very good questions. For many questions, there are no answers. That is the beauty of digital taxation today. But anyhow, don't give new ideas for large corporation. Of course, yes. People like you are always supporting them to have good ideas. As you say, tomorrow, if they are paying the digital tax, again, they would collect it from all the users. That's a very good proposition. So as of now, they may not do that because the user base is very, very critical for them for their intellectual property. But definitely, how this is going to operate in a practical manner is a big challenge. It is not so easy to arrive at a taxing rate so easily for the markets, because the formula they have proposed is highly subjective. You will have to arrive at the consolidated group profits, and without making any adjustments under different gaps you have, that is the accounting practices you have. And again, you will have to differentiate between different businesses, different lines of activity, different regions. All these adjustments are going to play havoc. How they are coming to a consensus is a big challenge. And if at all they decide taxation on the user base, Suppose you are out of country for 3-4 months, as you say, they can easily capture where you are a user for those 3 months. So you will become a user of that country for those 3 months. So probably how this rule is going to come out, we have to wait and see. Capturing that data is not a challenge. That can always, suppose in a year you have used it, you are in US for 4 months and you are in India for 8 months, then your usage can be easily apportioned to both the countries.
Yeah.
Yes, next question.
Yeah. Next is from CS Subramaniam. He says, sir, your presentation is structured well to reach the audience. I should thank you for excellent presentation. And then he comes up with a question. The efforts of OECD or UN to bring in equity to international taxation is noteworthy. But despite these efforts, we seem to be facing one complex transaction after other, bringing in the international scenario, contributing to the inequity. I consider more source rule should take over the majority of the transactions, giving up the traditional residence rule. So he's just giving an opinion and he wants you to
Okay.
take up.
No, I appreciate his point. It's well taken.
Thank you, Prasad. I'll just go to next question. 1 second, and just yeah. Next question is from PS Narayana. When remittances are made, I think this I'll read it a bit slowly, Prasad.
No problem.
Because when remittances are made from A country to B country, with a request to render the service in C country for the beneficiary who is in D country, what is the source country to be taxed? Is it the remitting country?
No, as I understand, there are 3 countries here.
Or 4 countries.
4 countries. Can you just read that sentence again?
Yeah, it's at 12:16 p.m. If you can also check the Q&A, you'll see 12:16 p.m. Narayana PS. I'll again read it. When remittances are made from A country to B country,
Okay.
with a request to render service in C country for the beneficiary who is in D country.
This is 1216 or 1219. What is that?
12:16, 1 to 12:16, Narayana PS.
1216. See, I'm having 1210 and again 1219 is coming very surprisingly in the chat box.
Yeah, maybe no problem. I no, don't say Q&A. You have to see Q&A.
Q&A. I have to see
Yeah.
Q&A. Okay. Not chat box. Okay.
No.
When remittances are made from
A country. Yeah, I'll read out again. When remittances are made from A country to B country, with a request to render service in C country, or the beneficiary is in D country, what is the source country to be taxed? Is it the remitting country or the receiving country or the delivering country?
Okay. No, this is a very complex question, but can be answered. What I mean to say, this is a triangular issue in the treaty network. That is what we call. And in simple terms, I will put it. If at all you have a branch in, say, US, say in UK, and you are taking service from US service provider, and you are asking him to provide that service to your branch in UK, the service is rendered in UK. UK in turn is giving this benefit to its sale happening in Norway, let us say. So that is what is the example he is giving. Suppose your branch in UK is availing service from non-resident for the purpose of branch profits. Under section 917B, you have an exclusion because for that the source is shifted to that country because it is for the purpose of business activity of your branch in the UK. So that would not get taxed in India. That would get taxed only against the income you generate in the UK branch. Again, you have a challenge. UK branch is utilizing it with with another country where your end customer may be there, but in spite of it, it becomes UK's profit, and it would become a source of UK for the purpose of taxation, not India. That means, in your example, it would be country B or C. I think country C. Country C. Okay.
Prasad, I'm reading two questions. If you see, again, because two connected questions, Srilekha 12:19 p.m. and Manoj Agrawal at 12:22. Okay. Please throw some light on marketing intangible case laws as per Income Tax Act. And Manoj Agarwal continues, in marketing intangibles, if unrealized profits are taxed Y on Y, are these taxed again at the time of exit or sale of the brand by the brand owner? 12:19 and 12:22.
Yes, I have seen the Manoj Agarwal. 12:19 is also on the same. Okay. I have seen Sri Lekha and Manoj Agarwal.
Yeah.
I have seen that. What I mean to say, marketing intangibles, you have got Maruti Suzuki's case, you have got LG's case, and you have got other cases which I can forward to, Pankaj.
Yeah.
What I mean to say, marketing intangible is taxed only in that year. Whether you have marketing intangible on the as per the bright line test which they have put in the LG's case special bench, the bright line test has been negated by the High Court, stating that bright line test is no more acceptable. So again, it takes time for me to explain what is bright line test and all that. So they will have to pay tax only as per because that is the reason. Now this issue is pending before the Supreme Court. We expect Supreme Court to give its final verdict somewhere this year. Then we will have finality. Pending that, as of now, the bright line test would not apply to the marketing intangibles, and thereby not every intangible increase can be brought to tax in India, like routine and non-routine profits we cannot. And what the High Court said is, whatever pricing you are doing, that pricing itself is taking care of whatever extra profits you are trying to capture here. So you cannot bring anything more extra like that. That's what is mentioned in the High Court judgment, and that is now pending before the Supreme Court. Yes, you can go ahead.
Before I just go to any other questions, Madhubala Nahar, I think she's a very famous name for all the chartered accountants. Yeah, and she's offering her assistantship to you, praising you that you have been very good on this topic. Okay, okay, right, okay. And just one more question is, please explain the amendment brought in by Finance Act 2019 to Section 92D. If there's any change in the old law and the amended law.
92?
2019 to Section 92D.
92D is documentation. 92D is nothing but documentation on the transfer pricing principles. The documentation, there is no change to that. We have a three-tier documentation now for large companies. That is, country by country reporting is there if at all their turnover is more than 5,500 crore. The same 750 million euro, 750 million euro. And you also have a master file application, and you have the regular documentation which is called the local file. 92D read with rule 10, rule 10D. So you have the same documentation. There is no change in that, but that goes on. Whatever is brought under 2019, actually it is brought in 2018 itself, made effective from 19 onwards. Okay.
Yeah, and one quickly, I'm just reducing the question. The gross debt amount of TDS, wherever we gross up the amount, is that gross debt amount is also an can be claimed as expenditure?
Yes, definitely. But the only thing is, the grossed up amount will become your cost. And suppose 100 rupees, $100 net you are making. Just for our understanding, if 100 has become 107 or 108 in grossing up, let us say 110, it has become 110 in grossing up.
Prasad,
110 would be your cost.
yeah.
Am I audible?
Yeah, now we got you back, right?
Okay, so that is cost, but only thing is, this TDS certificate you will have to issue to the person, but that person you will not issue for the simple reason because he didn't allow you to deduct it from what he has to receive. He made you pay it from your pocket and then gross it up. Then probably when he asks for a withholding tax certificate for the purpose of credit in his country, you can always insist share the taxes. Otherwise, you will not be giving the certificate. But definitely, it would be your cost.
So we are not opted for safe harbor rules for an international transaction and have determined the ALP at 15% as per TP study. However, the TPO is determined at 26% as ALP. In such case, can we now opt for safe harbor and opt 20%?
No. That can't be done. It has to be done at the time of filing the return itself. It can't be done now. And you will have to fight it out legally and try to establish that your TP study is correct. And the functional analysis, what you have done, has rightly been done. Thereby, the profits reported by the Indian entity are appropriate. That is what you need to establish.
Prasad, I'll just jump a couple of questions and go to question from anonymous attendee. In case of an equalization levy on non-resident e-commerce operator, the seller is required to pay equalization levy instead of buyer, like in online advertisement. How the government will have control over non-resident operator when they don't have any PE and does not have any bargaining power from the countries like USA?
Yeah, I agree. This is a challenge for the administration. But whenever you are allowed to operate in country like India, there are certain restrictions and there are certain registration formalities which they need to do. If at all government's taxes are not paid, definitely they can have their own say in stopping the business activity in the Indian market, because now you are already seeing the data localization and all that, and India is favoring data to be localized, and it has to be on the Indian servers, and these are all the steps to ensure that proper control is to be exercised by the Indian government against these non-resident operators. And definitely they can exercise control, and that should not be a big problem, because even non-resident e-commerce operators in a growing market like India, in a potential market like India, would not default. I'm telling you, they will definitely comply with the law and try to progress their business. They will try to earn more profit, and they would not default on that. They are not like people who are coming for a small period and going away. So that way, it would not be that they will not comply with the law. But only thing is, this would be withdrawn if at all a proper consensus taxing right or taxing rule is going to be arrived at by OECD G20 initiative by end of this year. So till such time, they would definitely comply. They made their request. Google and Facebook have already, represented, though they are not acting as e-commerce operators. They are making a representation not to take unilateral measures in India, like equalization levy. Because Google is already impacted by 165 because of the online advertisement and all that. Yes.
Yeah. One second. In fact, there's a message from Dhanivas. He says that Chairman Dab has called him. But anyway, I'll just take a couple of questions. Dhanivas, if you are there, come on video. Otherwise, I'm taking another question. Amazon India Limited is an Indian company. Hence, these taxing provisions may not be applicable. Am I correct?
No, if at all Amazon India is operating the platform, then there is no issue. To become a resident, it would be fully taxed in India. No, it would be fully taxed in India. If at all the operations are divided between Amazon US and Amazon India, what Amazon India is doing is already getting taxed. So that is where we need to see If Amazon US is doing some online sales, then it would be subjected to the new equalization levy.
Yeah, thank you. And Bharat Kumar Behra says, please elaborate on extended levy on e-commerce operator as per Finance Act 2020 versus equalization levy at the rate of 6% on specific services received from a non-resident as per Finance Act 2016.
See, he is Mr. Behra. What is his full name?
Bhaskar Kumar Behra.
Bhaskar Kumar. It's a good question. Actually, equalization, briefly I would tell you because for want of time, equalization levy in 2016 under section 165 is an obligation cast on the payer, that is the resident payer who is availing the online advertising services from non-resident companies. And that 6% has to be deducted by the payer. He has to comply with the, the documentation and all that. Now, the extended equalization levy is the obligation is cast on only the non-resident and not on the resident payers. That is a very good change. But only thing is, there are certain similarities. There is a view that this 2 crore limit, it has to be applied payer specific and not a consolidated threshold. But the clarity is yet to come. Because when you go to equalization levy under section 165, that whatever threshold that was there under 165 for online advertisement, it is payer specific and not aggregate, because the obligation is kept on payer. Here, the obligation is kept on the non-resident payee. They have not, they have said it's an aggregate thing, but still some scholars feel that this is an issue which needs to be clarified. So as of now, that is what, and you have a penalty, you have interest and all that. And as far as appeal, I am told 165A is not very categorical on the appellate rights under 165A, which I am yet to examine, so I am not going to talk on that. Whereas you have the appellate proceedings available for 165. So we can go to the next question.
Yeah, sale of shares allotted to Indian employee of a foreign company who resides in India. The shares listed in US stock exchange only. The income on sale of shares, whether it is taxable in the hands of Indian employee. If so, under which head, please advise.
No. Indian employee means, is he residing in India or is he residing in US? That must be clear.
No, obviously he must be referring to that ESOPs allotted to employees,
Okay.
Prasad. So I think they are all listed outside.
Okay. So ESOP, and broadly I'm answering. I'm not going into the details because there are some issues in that. Broadly, it is an employee of a subsidiary getting shares from the parent company in US. So the ESOPs are coming as an employee of a subsidiary. So definitely it would be liable for tax here only because you are a resident of India. Though the source is in US, still the global income is going to be taxed in India. You would be liable for tax in India only. You can't escape the tax.
Yeah, and the sale of shares should be taxable under capital gains. So the head is what is asking. At the time of allotment, it's a perquisite.
Yes.
At the time of sale, it will come under capital gain. No?
Yes.
Hello, are you there?
Right. That's correct.
Yeah.
Yes. Yeah. Am I audible?
Yeah. Yes.
Am I audible?
We lost you. Yes, Prasad. And the
Yes,
next question.
Yes. It becomes a perquisite at the time of vesting, and then at the time of sale, it's capital gains.
Yeah. Thank you. I think Anand Sharma is very ahead in times. So Facebook has invested in Reliance Jio, and Facebook hereby owns 10% of it. Now Reliance is planning to use WhatsApp, which is owned by Facebook, for its JioMart venture and for their new payment app as well. How is this transaction be treated for tax purpose if the plan is implemented by Reliance? So I think, yeah.
It's a question to be answered in the chamber and not in the.
Yeah, and sufficient billing should be required. Okay, Prasad. I think Prasad, I think we are short of time, and I think we have one more seminar. So I think there are 5 or 6 questions which are there. So Funny has also joined. So what we'll do is we have been talking also for 2.5 hours continuously. So I request Funny to kindly give the closing remarks. But just before that, 1 second, Funny, I'd like to tell everyone that we are planning for webinars, but there are some institute rules which are coming in between. Even our plan of jointly being encouraging the other branches, joint seminars are also, they are coming out with some or the other directive. So give us couple of days to just look at the rules, because we don't want to be on the wrong side of law. So couple of days we might just stop it, and then we come back with a new series, new webinars, and jointly with all the Nizamabad chapter and other branches also. So I think there as also there he can comment, and then Funny can just close it. Thereby for the people are asking for the new webinars.
Sorry, I have been on the last batch.
Yeah, why Kattappa killed Bahubali? So they want the answer. You can't stop at Kattappa killing Bahubali.
No, we are going to come back very soon with a big bang, and be ready. We are all going to be there again. Hopefully from 1st of May, it's going to be one more series which we are going to start. And thank you very much, Prasad sir, for giving your time, energy, and your thought process on this entire international taxation. Though I was off and on here there, but I tried my level best. But I just paused my discussion in forensic course. Today is the first. We are very proud. It's a proud feeling that first ever certification course did in our institute is our forensic course only. So I was doing so, but before that, I wanted to come back to my home and be there. And thank you very much for coming in there. Funny, thank you very much for giving us an opportunity to help you out. And Pankaj bhai, as usual, you are the century batsman.
Yes, Funny.
Yeah. First of all, I thank the speaker, Sri Prasad, PVSS Prasad. You have enlightened us with the latest amendments and latest case studies, and with all latest examples, and you have enlightened all the participants with the latest budget amendments. So I personally thank the Hyderabad branch to for giving their support, technical support, and I thank the participants who have actively participated for the 2.5 hours session with such a valuable questions. And I thank the speaker once again for giving us Nizamabad chapter the opportunity to conduct this webinar, and also giving a valuable valuable speech on the digital taxation. Thank you very much, and thank you, Dayanivas, for your efforts. And we are from our side, we are always ready for hosting these seminars, for conducting these webinars. So I thank you one and all once again. Thank you very much.
Yeah, thank you, Funny. Hyderabad will always be for you. Prasad, you want to say something? Voice, you have to unmute. You have to unmute yourself.
Unmute.
Okay, I have unmuted you.
Okay. So I'm very happy to be part of this webinar, and I mean, nice support from Funny and Pankaj, very nicely, and Daya is always there. And thank you, all of you, for giving me this opportunity to share some of my thoughts on this most important Funny and Daya, and all the audience who have participated for such a long time.
So thank you very much, Funny. Thank you, Prasad. Thank you, Devi. I am doing an end meeting. Thank you.